So, you're at university. You've learned how to cook toast without burning it, and you spend more time partying than you do studying. Overall, you're doing the student thing, and it's pretty good. But every hangover morning when you check your bank account and realise you spent more money than you should, you're safe in the knowledge that it's only a few weeks until a load of money pops in, aka your student loan.
These words have been floating around for a while, but I'm guessing you don't really know how it all works. Too much maths and scary words, and you're hoping it'll all just come out in the wash. So I'll try and set you straight without dragging out your attention span.
So, as of 1990, students have been expected to contribute towards their university costs and have been able to borrow money from the government at the start of their study and pay it back once they have graduated. So far, there have been 3 different styles of loan. From 1990 to 1997, there were mortgage-style loans. From 1998 to 2012, there were income contingent loans. Then from 2013, they tweaked them a bit, so now they're income contingent loans plan 2.
We'll start with the oldest one, mortgage-style loans. Providing your income was at least 85% of the national average income, you had to make repayments, else you could defer. If you did, interest would be added, but only to keep up with inflation. So in relativistic terms, your loan didn't increase. Once your income was over the threshold, you had from 5 to 7 years to pay it off by making monthly repayments. Once you were earning enough, the amount you would repay each month would be calculated by the size of your debts plus interest divided by the number of months you would take to repay it. The basic version is given by the formula here, assuming yearly interest rates remain constant.
As this was irrespective of income, if you were just over the threshold, then up to 75% of your income pre-tax would have to go towards paying your student loan, which resulted in some people having to take out additional loans to pay off their initial loan. Pretty messy. So in 1997, the government knocked their heads together and came up with a new system.
For students studying in 1998, the repayments were now going to be income dependent, and the debts would be wiped off once you turned 65 if they haven't been paid off. So instead of making the same payment each month like before, it was automatically taken off your salary at the rate of 9% above the threshold, which started at 15,000. As an example, if your salary was 17,000, then as this is 2,000 above your threshold, you take 9% of 2,000, which is £180. So you would pay £15 a month. If your salary is £30,000, then 9% of 15,000 is £1,350. So you would have to pay £112.50 a month.
If we incorporate income tax and national insurance into these figures, then from a 17,000 salary,
£14,760.84
would make its way into your bank account, and from a 30,000 salary,
you'd get £22,430.88.
Whilst additional voluntary repayments were available, it was generally better not to, as the interest on the loan was so low, lower than the interest you could get on savings in a bank, so you would end up making more money from saving it than paying it off. Unless you're on a ridiculously high salary, but by that stage you'll probably be doing some dodgy stuff in some offshore accounts anyway.
The amount the loan increases per month is the lower of either the Bank of England rate plus 1% or the rate of inflation calculated the previous March. Hence, the overall value of the loan will decrease with time. From September 2006, the threshold salary went up at the same rate of inflation. So by 2012, it had increased to £18,300.
In 2012, the government decided to change it up again, but as the current system seemed to be working pretty well, it wasn't a drastic change. They changed the threshold to £21,000, increasing with inflation, the interest rate to 3% plus inflation, and the loan's lifespan to 30 years after graduation. It was also written off if you became permanently unable to work or died. So that's nice.
In order to determine which is the best of the 3, we had to make a few assumptions given here. We could then create a spreadsheet comparing all 3 to see which was the best. We found that mortgage style was paid back after 5 years, Plan 1 was paid back after 25 years, and Plan 2 was never paid back but was wiped after 30 years. We also found that with the mortgage style loan you would end up paying the least back, and with Plan 2 you would end up paying the most. However, with the mortgage style loan you'd be paying almost £46,000 back over 5 years, whereas with Plan 2 you would end up paying almost £8,500 more, but over a period of 30 years. So each repayment is much smaller and much more affordable. Calculating consumer leverage ratio shows how much of your DPI goes to your loan. The highest in Plan 1 is 6.14%, in Plan 2 is 5.62%, but in the mortgage style is 31.75%, which is very high. So overall, Plan 2 is the best, which is what all current students are on, so even though we'll probably never pay off the debt, it is the best of the 3 styles that have been around. Still, it would be nice if the interest wasn't so high so we actually had a chance of paying it off.